Okay. So when we started initially with management accounting, we learned that there are three major techniques or three major reasons why we carry out management accounting. One, that is what? To assist management in planning, controlling, and decision making. And I told you that decision making, how do we use decision making in management accounting? There are various, excuse me, management accounting techniques where we take decisions. Okay. So we are going to look at some principles of decision making. Okay. And techniques and models that we may use to take those decisions. Now, businesses face many different types of decisions, ranging from strategic choices, such as should we enter a new market, to tactical ones like should we make a product ourselves or outsource it? Should we shut down a particular division, right? An operational decision such as how do we reorganize our production to maximize profit when half of the workforce are off sick this week, right? So all these things are all decision making. Now, solving such decisions will involve a mixture of quantitative and non-quantitative factors, right? Or what we call qualitative factors. Now, here we are mainly concerned with quantitative analysis. So many different techniques have been developed to assist with decision making. This can be loosely grouped into the following, like long-term decision making, which will involve the use of discounted cash flow techniques, right? Which I said we call capital budgeting or investment appraisal. Then we have short-term decisions, which involve looking at what? Which involve looking at what? What's the word there?
Contribution.
So you remember that straight from the start, I told you that anytime it comes to management accounting, anytime you have to take any decision in management accounting, think about what?
The contribution.
Contribution. Because contribution is a profit which can cover fixed costs. And because fixed costs are fixed, it is usually possible that a business does not have enough leverage, right? Like the business has so much fixed cost that its contribution, I guess, it cannot cover it, and then it results in a loss. But that contribution, if it exists, it covers some costs, which are your variable costs, right? It means that if you do not have contribution, then you do not even have the power to even cover your variable costs. Do you understand? So if you are dealing with a business that has at least a contribution, it tells you that yes, it has been able to cover variable costs, but maybe it couldn't cover its fixed costs. That is why contribution is very relevant for decision making, right? So apart from looking at discounted cash flow techniques, we'll look at short-term decisions where we normally use contribution, or where we have decision making with limited or scarce resources, which is limiting factor decisions. And then we look at where there's risk and uncertainty, right? Like where you are using expected values, sensitivity analysis, and also the concept of certainty equivalence. Okay, these are some things that we are going to look at. Now, with any decision, it is vital to understand what is trying to be achieved in the first place, as this will influence the method that you are going to use. Okay, remember that the most common objective of every business is to maximize shareholder wealth or shareholder value. And this is because most decisions are made by companies where the directors have a duty to act in the interest of what? The shareholders. Okay. Are we okay? So that is the most important one. So always have that in mind. Is that okay? Okay, so why is it important to develop decision-making metrics that will maximize shareholder value? So every business that exists to maximize shareholder value, right? And one thing that you have to look at is that why are we not just talking about profit maximization? Because maximizing profit is not necessarily a sufficient financial objective, a sufficient primary financial objective. And this is because cash is preferable to profit, right? So cash flows have higher correlation with shareholder wealth than profit. And two, it exceeds mostly the cost of capital, right? So we are looking at your cash flows that will be generated over some particular cost that you have to pay. So the return, however measured, must be sufficient not just to cover the cost of debt, for example, exceeding your interest payment, but also the cost of equity. Now, Peter Drucker commented in a Harvard Business Review article, until a business returns a profit that is greater than its cost of capital, it operates at a loss. So you may be showing a profit on your financial statement, but you are not actually having a profit. Never mind that they pay taxes as if it has a genuine profit, right? The enterprise still returns less to the economy than it devours in what? In resources. Until then, it does not create wealth. It rather destroys its wealth. And the whole thing is that when it comes to decision making, right? We are saying that, okay, there's an expected return that your shareholders want or your investors want. You should be able to generate a sufficient return that exceeds that amount that your investors want, right? And also there will be the what, when you are considering increasing shareholders wealth, you have to manage both short and long-term perspectives, right? Because investors are increasingly looking at the long-term value of the company. That's why they invested for the long term. And when valuing a company shares, the stock market places a value of the company's future potential and not just its current profit levels. So company announcements about capital expenditure, R&D, or new investment are often treated as positive rather than negative factors by the market, even though these announcements may have a detrimental effect on short-term profit. Something like new biotechnology companies, right? For example, they clearly have what? A value despite the fact that many currently have no product. Now, one thing that I'm trying to draw your attention to here is that no matter the decision-making technique that you take, okay, the end result is that you will maximize the shareholders' wealth. And shareholder wealth comes in the form of cash flows, right? And not necessarily profit. Usually, when we get to discounted cash flow techniques, you understand it better. Usually, contribution, okay, usually comes with your operating cash flows. Okay, so when we look at relevant costs, you will understand what relevant costs mean. Okay, so let's look at short-term decision-making techniques. Now, in short-term decision-making accounting, a significant portion of the manager's time is spent in filtering management information. However, the amount of information available to the manager is almost infinite, complex, and mixed. Therefore, the manager, being inundated in a sea of data, must carefully select those information that is only relevant to the decision-making and ignoring the irrelevant ones. Okay, so the whole thing is that with what they are saying here is the same thing that comes to exam. When you get decision-making questions, most of the time, they will give you information that is irrelevant and information that is relevant to the decision, okay? So different decision will require different types of data, and an important part of any decision is the relevant cost, okay? The cost that is relevant to that particular decision. So therefore, the management accountant may be faced with a variety of decisions that rely on cost data, such as whether to purchase a new plant or equipment. This is a full question that can come. A decision to replace existing equipment, a decision to enter into a new market with a product or not, a decision to take a special order at less than full cost, to make or buy or outsource components, to price product differently to customers, to shut down a particular division, to further process what? A particular product. All these things are decision-making techniques that you can have at your disposal. Now, you may also go to the exam and encounter some decision-making that you have never seen before. Now, the question is, Bill, how is that possible to go into the exam and encounter decision-making that you have never seen before? Yes, the thing is, once you know the principles of contribution, okay, if you go to the exam, weigh the data that they've given you, and at least you can get more than half of the mark. We are not fighting for all, because I told you, in management accounting, my target for every student to make management accounting easy for the student is this one. models of evaluation, right? So for models of evaluation, my focus for the students is that this area, master it, is 15 marks, right? 2, master variance and standard costing, which we call management accounting techniques, right? That is also 15 marks. Okay, then third is performance, which is 20 marks. How many marks do we have so far? How many marks do we have so far?
50, 50.
Then investment appraisal, making 15 marks. How many marks do we have now? Is it not 65?
Yes.
So for my students, this is your exam focus, right? And trust me, if you go by this route, you are going to be safe. You are not going to struggle with management accounting is always a sure banker. That does not mean you are going to ignore short-term decision-making techniques, which we are going to do now, right? That doesn't mean you are going to ignore this, which is 20 marks, right? And then budgeting, which is 15 marks, right? Making what? 35. But I'm telling you that your chances of passing are more here than here. Even if you are the most strongest person in management accounting, there's a chance that the short-term decision-making technique that they bring may be a little confusing, right? And it's not the confusion that will take that I said do not really put your hope and trust here too much, but rather the time spent, right? You see, the paper is only 3 hours. And you see, you have all these things to tackle. And you see, some students who go and focus on decision making, they do not get it, they cancel. They go and try the budget, maybe it's a cash budget, a long one. They end up canceling. So these questions are time wasters, right? It doesn't mean you not do them. They are time wasters. So I tell the student, focus on these 65 marks, master these ones, right? This one, no matter what, you will do it. Yes, you know, but attempt all these ones first. Then you go and pick easy marks, right? Like relevant course, you go and pick the easier ones you know. Budgeting, you go and pick the key points that you know. Then you leave it. At least out of the 35, if you're able to get some what? Some 20 cry, it's not bad. Why? Because you've already tackled 65. Do you get my strategy? Me, exam is not just knowledge for me. It is strategy. If you know the right strategy, me, I was able to do more than half of management accounting within an hour and a half, right? I attempted all 5 questions. I knew I could get 100%, but I was very ill. So within an hour and a half, I've done what I can do. You get the idea? And I was still able to cross 70%. I knew that if I sat within that 3 hours, I can get 100 over 100. Because the thing is, it is strategy. And I keep telling students that it is strategy. If you want to pass any exam, it's not about the knowledge. You may read book cover to cover, you may still go and still get confused. I told you with every management accounting technique you are learning, first, if there are definitions, know the definitions there, right? If there are some concepts you need to understand, what is the concept, the main concepts behind it, right? Now, you have to ask yourself, how is this model similar or different from other models, right? Then the last thing is that if there are any calculations, how do we do those calculations? And then are there any disadvantages and advantages of this model? See, if you learn anything you see like this, if you go to the exam, you have a sure chance of getting over 90%. Why? Because if the examiner is examining a concept in management accounting, he can come from the point of concepts and definitions. He may come from the point of what? How is this similar or different from this? A typical example is this thing. What is the similarity between MPV and maybe economic value added? A typical question they can ask you, right? Maybe if you learn MPV and you know how it is similar to EVA or how it's similar to RI, it will help. What are the particular calculations involved? What are the disadvantages and advantages of that model? You see, if you have a systematic way of doing things, everything becomes simple. Do you understand? So I keep telling you, if you want to pass, management accounting is a hectic paper. You can fail more than 9 times. You can fail more than 20 times. If you do not have the right approach, it is the approach. It is not the knowledge, right? I keep telling people this. And if you adopt this style, ICA will be a sure banker for you. You are never going to fail a paper, okay? I hope that helped. I hope that helped.
Yes, sir.
Yes, sir.
So now any topic you pick or any particular model you pick in management accounting, what are you looking out for?
The definition. Concept. Advantages and disadvantages.
How similar is it to other models or how different is it? Are there any calculations? How do we do it? Right? Always when you have this mindset, it doesn't matter what you look for. You will always have a right way of learning and knowing different things, how they relate to each other, and then you'll be good to go. You don't learn in isolation, but you realize that almost all the techniques are interrelated. Okay. So then, when it comes, they can ask you about the decision-making process, right? So with the decision-making process, there are many ways we look at it, right? You identify a problem, you gather data about the problem, you develop alternatives, you select the best alternative, right? And then you monitor your performance. It goes on and on and on and on, right? The same approach. Now, what I want to talk about in decision-making is what we call relevant costs and revenues, right? And this one, I wouldn't use the book. I want to make it very practical for you. Okay, once you understand these techniques, trust me, there's no question that can beat you. I prefer rather you understanding than you just solving questions blindly, right? Because I told you every question is different in its own way. Do you remember? Do you remember I said this? That every question is what? Different in its own way. Claire? Are we okay?
Yes, sir.
Okay, that's fine. So let's look at what we mean by relevant costs and revenues, or relevant cash flows, or relevant data, right? So if you go to the exam and they ask you about relevant costs, right, and revenues, so relevant costs and revenues, or simply relevant data, right, or relevant information. Now, relevant cost refers to one future, you should be writing incremental cash flows, okay, that arise as a direct consequence or a direct result of a decision. So in simple terms, when we say a cost is relevant, it means that because you took a particular decision, that cost arose. Okay. And now look at the mechanics here. A relevant cost or revenue should be incurred in the future. That means it should relate to something you are going to do in the future. Now come and teach you irrelevant costs. I'm coming. It should be incremental. The word incremental could be what? Could be what? The word what? Additional, right? So that means it should be what? An additional cost, something that came up as an incremental, an additional or a reduction to something, right? Or something that is what? Differential amongst alternatives, right? It differs amongst alternatives. For instance, if I will eat banku, it will cost me 40 cedis in this cafe. If I'll eat banku in this cafe, it will cost me 50 cedis. What is the relevant cost? What is the additional cost that is incurred in either alternatives? The additional cost or reduction, if I choose this or I choose this. Yes? What is it? This session is supposed to be active so that you understand it. If you don't talk, you won't understand. Relevant costs cannot be teach and listen. You have to answer me when I talk, right? So if I decide to choose 40 cedis, how much am I saving without choosing this 50?
10 cedis.
10 cedis, right? So this is like the extra cost, right? That will be incurred if I choose this one. And the cost that will be saved if I choose this one. True or false?
True.
That is what we call the incremental cost. And you see that this 10 cedis differs amongst alternatives, right? And led to 40 and 50, right? It's like, see, 49 plus or minus 1, right? Plus 1 will give you 50, making you pass. Minus 1 gives you 48, still a fail, right? This is what we are saying, making this one an incremental, right? Or a differential. So a differential cost is a cost that differs amongst alternatives, right? And I said what? One, a relevant cost should be a future cost. It should be incremental. That means it should be additional. It should be differential, meaning it should differ amongst alternatives. And it should be a cash flow. It means that non-cash flows are not relevant for decision making. What did I say?
Non-cash flows are not
Are not
relevant for
what
decision making.
Yes. And what is that? Because non-cash flows are based on estimates. And anything that is an estimate is not a cash flow, right? And therefore, it is not relevant for decision making in management accounting. So I've told you that one, okay? And then we said what? It should arise as a direct consequence of a decision. So what I'm saying is that, let's take an example, a simple example, right? So we have a warehouse, okay? Or we rent a warehouse, and the rent we pay the landlord is what? 20,000 Ghana cedis per year, right? Or per annum, okay. This is the warehouse that we have. And currently, we are receiving what? We want to do a special contract, right? A special contract which will require what? An additional space, right? An additional space of, the landlord said that, oh, we are his normal customers. So instead of paying additional, instead of paying extra, we should just give him a total of 35,000 for the 2 rooms. My question is, what is the relevant cost here? What is the cost that arose as a direct consequence of our decision? What is the cost that arose because we wanted to take up this special contract?
15,000.
15,000, right? So you are saying that the incremental cost or the relevant cost here is actually what? The extra, right? That is the 35,000 minus what? The 20,000 also, resulting in what? 15,000. So the question you can ask yourself in most questions, right? So that you don't what? You don't lose is that you say what? Assuming I didn't take the decision, what cost would I not incur? Or what cost would I save? So assuming I didn't go for this special contract, how much would I end up saving? Or how much
15.
would I spend? It's 50, making it relevant for this decision. Does that make sense? So even for me, relevant cost is this whole thing. You can use this to answer exam questions, and it is far easier to get, right? That, okay, what cost came because of this particular decision? If I didn't take this decision, would I incur that cost? If you didn't take the decision, that cost will not be incurred. It makes it relevant. Does that make sense?
Yes, sir.
Okay. So write it down. Relevant cost and revenue are future incremental cash flows that arise as a direct result or direct consequence of a decision taken, right? Meaning no decision, no cost. Yes decision, yes cost. Understood. Did it make sense?
Yes, yes. So, sir, please, the reverse. So does it mean that the reverse is that for relevant revenue?
No, it's still the same. They all follow
Oh, okay.
criteria, yes. So look, I am going to do a contract, right? I'm going to do a contract. I will earn 25,000 cedis per annum for the next 5 years. Is this not relevant? One, is it not in the future? It is. Not so. Is it not cash flow? It is. As of now, do I have anything? My revenue position is now 0, right? But in the next year, I'll be earning 25,000. What is the incremental? Is it not plus 25,000? Is this not incremental?
Okay. Yes, sir.
Because of this contract that I'm incurring this revenue, it is. So future, incremental, cash flow arising because of this contract, making this revenue relevant for that decision.
Okay. Yes, sir. Thank you.
For revenues, it's easier to say it's relevant. But when it comes to cost, that is where a lot of issues are, right? And that is what we are going to dissect in these few minutes before we start moving, right? So I'm going to create a simple table and group what? Relevant and irrelevant costs to your understanding. I hope that is okay. But I hope you've got the basics. Can we move? Can we move?
Yes, sir.
So create a table in your book. If you have your book, let's write a nice table and put here relevant costs. Okay, relevant cost, and put here what? Irrelevant what? Irrelevant cost. So I'm going to give you the different types of relevant costs. First, we have future costs, right? So all future costs are what? Relevant costs. But then I'm going to tell you something. That means that all what? Past costs are irrelevant, right? So past or management account, we call it sunk costs. So all sunk costs are irrelevant, and all committed costs, I'll come and explain what that means, is irrelevant for decision making. Let me explain. We said that if a cost is relevant, it's a future cost, right? One. But then there are some costs that look like they are incurred in the future or they'll be paid in the future but are not relevant. Can I give you an example? So we are in which year? Let's go back to our warehouse, right? We are in which year?
2024.
2024.
2024.
And then we want to carry out a project in 2025, right? But we still owe the landlord rent for 2024, which we decide to pay in 2025. Let me ask you, that rent that we are going to pay in 2025, is it not a future cost or is a present cost?
The past cost.
It's
Yeah.
a future.
Though it will be paid in the future, when was it incurred? Are we not committed to pay it? So whether or not this project comes on or not, are we still not going to pay the landlord the 2024 rent?
Yeah.
Making it irrelevant. So be careful. Because we say future costs are relevant costs, a question will lie to you and tell you that, oh, though you are doing the project this year, you had some costs which you had incurred already. Okay, but it's not yet paid. You are yet to pay. Though you will pay in the future, are you not committed to pay already? You are committed to it. And anything you are committed to becomes irrelevant for a particular decision because it does not belong to that decision. Makes sense? Does that make sense to everyone?
Yes, sir.
Are you sure? Are you sure you get it? Please, here, there, you have to be absolutely honest. So if you don't get anything, you have to tell me, because this is what you are going to use to build on to solve questions. So if you do not get the basics, when we build on, it's going to be a problem. Are we okay? So feel free. If you have any question, you just go down, ask. I'll go over it again until you get this. Is that okay? Is everybody okay? So these ones are sort of, this one is completely past cost. Let me give you an example, right? We want to build a factory, right? So we want to build a factory. So we did research, right? We did research whether we should build the factory or not, or we did a feasibility study. Just give you the typical questions that we normally have, right? A feasibility study, or you did some sort of due diligence to see whether this investment is worthwhile, right? So after doing this one, you decided, oh, this factory, we should go on with it or we shouldn't go on with it. Let me ask you a question. This research cost, is it relevant or is it irrelevant? This research or feasibility study cost, is it relevant for the decision or not relevant?
It's not.
Why?
Because it's something you conducted, which is in the past. So it becomes like a past cost.
Yes, it becomes like a past cost. And even if you decide to go to what? To do the research, to do the project or not, you have still incurred this research, right? So another third cost, which is irrelevant, is an unavoidable cost. Are we okay? I'm just giving you. So any cost which is unavoidable becomes irrelevant for decision making, because whether I do the research, if I do the research, okay, the project can come on or it cannot come on, making this cost unavoidable. True or false?
True.
After the research, I can say that, oh, it is not worthwhile, I'll not do the project, right? The project will not come. After the research, so I can decide to still do the project, right? Because it's worthwhile. So no matter what, whether I did I carried out the decision or not, that cost has already been incurred. So anytime you have an unavoidable cost, meaning that, look at it, Let me give you a typical example. I'm just giving you scenarios. This is Kofi, right? Let's see. Now, if Kofi stays home, look, Kofi stays home. Kofi is going to buy data of 25 cedis. Kofi goes to work, right? He's going to buy data of 25 cedis. When Kofi stays home, he's going to pay for food of 10 cedis. But when Kofi goes to work, he's going to pay for food of 20 cedis, right? What becomes a relevant cost here? What becomes a relevant cost? The question is, should he stay home or he should go to work?
He should stay home.
Should stay home, because if you put all the costs together, staying home means he's going to only spend 35, right? But going to work, Kofi is going to spend what, 45 cedis, not so. But then if you look at it, whether he stays home or goes to work, he's still going to incur data of 25 cedis, right? So it means that this is what? Irrelevant for the decision. Does it make sense? Because this is a cost that doesn't differ among alternatives. It is unavoidable. Does that make sense?
Yes, sir.
But look at the food. There's an extra he's spending of what? Of 10 cedis, which is the incremental or differential cost, right? The extra cost which will be spent if he decides to go to work. So Kofi should stay home because he's going to save what? He's going to save 10 cedis when he stays home. Or he should not go to work because he will incur an extra 10 cedis when he goes to work. Are you getting the picture now? Is it starting to make sense to you?
Yes, sir.
It's not anything difficult, but you just have to play smart and understand the principles. So, with what we have said, you now know what we mean by what? Unavoidable cost. We now know what we mean by what? Committed cost. Do you understand? So, let's see something here. How is this thing? So, I'm going to list all the potential relevant costs, right? So, we have future costs. We have incremental costs, right? I told you all incremental costs are relevant costs. We have differential costs, okay? So I'm just giving you differential costs are relevant costs. We have avoidable costs, okay? Now come and explain avoidable costs because we use avoidable costs to take decisions. So avoidable costs are broken into two, what we call what? Variable costs. All variable costs are avoidable costs. Then we have what we call specific fixed costs. So project specific fixed costs, right? So then we have 5 being opportunity costs. Opportunity costs. Then we have cash flows. So cash flows. And then we have what? All costs that arise as a direct result. No, so it's a direct result of a decision. Also, decision. The direct result of a decision. So this is what we have, right? Then let's come to irrelevant costs. The same way we say future costs, past costs, committed costs, unavoidable, so unavoidable costs, right? Or you can say what? Fixed or unchangeable costs, right? A cost that does not change. Okay. Then we have non-cash flows. Okay. So remember that cash flows are relevant, meaning non-cash flows, including allocated costs. Okay, so something that was absorbed using OAR is not a cash flow. So allocated fixed cost is an example of non-cash flow. Depreciation is an example of non-cash flow. Book values. I'm just giving you what you see in question, right? So when you see that, oh, they tell you that an asset had a cost of what? 2,000. Very good. Had accumulated depreciation of 100. So you have 1,000 naira as the book value. Remember, this book value has depreciation inside, making it irrelevant for decision making because it is a non-cash flow. And remember, it has the historical cost, which was incurred in the past, making this irrelevant for decision making. Are you guys following? So if you have allocated fixed costs, depreciation, book values, estimates, right? Like provision for bad debts, okay, provision for receivables, all these things are irrelevant. Then let me bring one last one, which we call notional costs, right? So I'll bring notional costs. And then I'm going to bring another one. I'm just giving you everything. right? I'll bring another one, which we call imputed interest, okay? Imputed interest, and I'll come and explain this better when we are looking at discounting, okay? When we are looking at discounting or cost of capital or interest, right? Now, let's first take the relevant costs one by one, okay? So first of all, we said that future costs are relevant, incremental costs, which are additional costs, right? Additional costs, and also differential costs, which differs amongst alternatives, right? Which differ among alternatives. And also, so Kofi staying home, Kofi going to work, you saw there was differentiation in the two costs. Then we have avoidable costs, right? Now, avoidable costs are costs that can be avoided when a decision is avoided. Do you understand what I mean? So let's say I go to Shell to buy petrol, right? The decision is to buy petrol. Are you listening? If I buy 1 liter, I incur cost for 1 liter. True or false? If I don't buy, I don't incur any cost. True or false? True or false?
True.
True. Making the variable cost relevant.
True.
The variable cost increase as level of activity, or they change with level of activity. So if there's no level of activity, there's no variable cost. Making variable cost relevant for all decisions. So anytime you go direct material, direct labor, direct expenses, variable overheads, and other variable costs are all relevant. Remember, they remain constant per unit. Do you remember our best friend is variable cost per unit? We know it's constant for the number of units that you are producing. So even if you are producing 10,000, 50,000, variable cost per unit is always constant. And we can use it to multiply those number of units, making them relevant for decision making. Clear? Is it clear? Is it clear?
Yes, sir.
You don't forget to. Then we have specific fixed costs. Now, specific, not all fixed costs. Remember, I told you fixed costs that do not change or that are located. I get it through OAR. If you see anything that is absorbed with OAR in a question, it is irrelevant. Okay. Now, why?
No, sir, your line is breaking since.
You said? Maggie, you were saying something.
She said your line is breaking,
But is my line breaking?
but no, I think it's from her end.
So anytime you see a fixed cost, right? This fixed cost is the one that we absorb or the one that is allocated by the head office or something. It's irrelevant because it's an absorption figure or an allocation, right? When we talk about specific fixed costs, let me give you a typical example, right? Okay. So let's say in my school, we have branches, right? So we have branch A and we have branch B. Okay, branch A is in Tema and branch B is maybe in Kumasi, right? And then the staff there are being paid fixed salary, right? The staff there are being paid fixed salary. The staff here too are paid fixed salary. Okay. Let me just give you a typical example. Now, this fixed salary, let's say they are paid 10,000 here. They are also paid 10,000 here. Now, if I decide to close down, somebody's back. Now, let me ask you, if I decide to close down branch A, right? Would I still pay the workers 10,000 every month? If I close down this branch, would I still pay the workers 10,000 fixed salary every month? Nobody is talking. If the branch is closed, do I get to pay the workers in that branch again?
No.
No. It means that this cost now becomes avoided, right?
Avoided.
It's an avoidable cost. But however, fixed cost shouldn't have changed, right? But this fixed cost, you see, it has a little variability to it. It is division specific, meaning it's a specific fixed cost, right? A cost that exists with some particular division. So once that division is closed down, that cost will also not exist again. Do you get it? Its existence is specific to something. So those kind of fixed costs are relevant because once I close down this branch, all the employees are not going to get their 10,000 every month again, making it relevant to that particular decision, to close down that division. Do you understand? And with me, my decision making is mostly taken with avoidable costs. I like that approach, right? I always use avoidable costs to take almost all my decisions, whether make or buy, shutdown, acceptance of a special order. I like to use avoidable costs because it sounds right, or opportunity costs, right? They make everything easier for you when you are doing decision making. But for exam purposes, we are going to focus more on differential and incremental costs, okay, for our decisions, but we know all of them and how they look like. But did you get the idea? So project-specific or division-specific fixed costs are relevant costs because they are avoidable. But however, what if the headquarters allocates electricity to division A of 50,000 and electricity to division B of 12,000? My question is, if we shut down this division, this 50,000, are we still going to incur or we won't incur again? If we shut down this division, are we still going to incur the 50,000 or we won't incur again?
We will not incur.
No, we will still incur because it's allocated by HQ. Do you understand? When HQ allocates, even if this division is no more, it will still be in the books that 50,000 has been allocated to branch A until HQ reallocates it to some other decision. You get it? That means this cost will always be there no matter what. But just that it may change its form. Do you get what I'm trying to put across? It means that when fixed cost is allocated, it's just a mere accounting figure that has been created. There is no cash flow. Do you get it? But the salaries I was paying to the staff, was it not a cash flow? Was it not a cash flow? Do you get what I'm trying to put across? Or it's not still clear?
So can you explain it again?
If you have division A, division B, division C, division D, right? This one uses 100 square meters. This one uses 200 square meters, maybe 300 square meters, and maybe 400 square meters, right? The total square meters is going to be 1,000 square meters at the line. Now, if there's electricity costs, or let's say rent, right? If there's rent expense of 100,000 cedis, now the head office would allocate it based on their floor area, right? We know that A will take 100 out of the 1,000 times what? Times 100,000, is that also? B will take what? 200 out of the 1,000 times what? The 100,000. True or false? Are you all following? Now, it will be allocated to all of them because they're fixed cost. But let's look at, what if we decide to close down B? When we close down B, still the same 100,000 will be shared for everyone. Does that mean B's cost is not there anymore? It's still there, but has been allocated in a different way. Do you understand what it means? Because these are just estimates. They are just estimates. They are not real, non-cash flows. They are not real cash flows. Diana, are you okay?
Yes, sir.
Do you get it now? But then the
Yeah.
salaries that I was paying to the people in B, if I close down B, would I actually incur those costs again?
No.
No. And it wouldn't be apportioned in any way because the people do not exist again. They are not there completely. The salary was cash flows that were paid to them. Make sense?
Yes, sir.
Are you sure it makes sense? Okay, that is fine. Okay, so now I hope you are all okay with avoidable costs. Are we okay with avoidable costs?
Yes, sir.
Please don't forget this. Every day there's a question around that area, so decision making will come. But I told you it's not really an area where you can, sometimes you can waste time. It's a time waster, but you need to know. I want to talk about opportunity cost, right? Now let me ask you. I have a decision. The decision is to eat, right? Let me ask you something. Now, my money available, okay, is only 10 cedis. I go to the restaurant, okay? I go to the restaurant and then on the menu, we have rice, okay, going for 9 cedis. We have banku going for 10 cedis, and we have fufu going for 11 cedis, right? Now, my question is, what is the opportunity cost if I decide to choose rice? What is the opportunity cost if I decide to choose rice? Yes. What is the opportunity cost if I decide to choose rice?
I see.
Is that? No, the opportunity cost will be what?
Please, can you scroll up a little? We can't see them.
Opportunity cost is the cost for
Banku. Banku.
Banku and
Banku.
fufu.
Banku rice will also be there.
it's because you don't
There is some.
opportunity cost, but
Or
you
is
are
that
just that opportunity cost. Somebody says they want
the
or go another one, right?
next?
But
Is the next available?
the next, okay, the next available, okay, the next available, I get to want, foregone to obtain what? The next best, let me use that word, the next best want foregone to obtain another. Do you get it? So if we decided to choose rice, what was the next best alternative to rice?
First, banku.
Banku, right? Within our income that we have, the next best alternative right, was banku, right? This becomes the opportunity cost, right? So if we take rice, we have forgone banku, meaning that we end up what? Saving the cost for banku and incurring the cost of rice. Meaning at least 1 cedi will now be what? Saved. Do you understand?
Yeah.
Yes.
So, but when we talk about opportunity cost in accounting or management accounting, is different from opportunity cost in economics. In economics, opportunity cost is true cost, right? From the economic cost is cash flow. Okay. Do you understand? And opportunity cost here refers to cash flow. No. It is different from notional cost. Let me explain. Now, we have this warehouse which we are renting out, right? And then we also have a project, okay, which is to use the warehouse to manufacture. So we have two decisions here. Use this warehouse to manufacture and earn 10,000 per month, or rent the warehouse out and get 30,000 cedis per month, right? Which is better? Should we use the warehouse to manufacture and earn 10,000 per month, or use it to rent and earn 30,000 per month? Which is better? Which is better?
Rent and get 30,000.
The question is there someone to rent right now? Get the idea. So if there's no one to rent right now, and then you are still thinking you can rent for 30,000, it's not real cash flow, right? You are just guessing. So this is what we call a notional cost. It is not real. You are saying that this thing can be rented for 30,000 per month, but is there somebody to rent now? If there's no one to rent now, this is just notional cost, making it irrelevant because there's no one to rent. But if there's someone to rent now, and you've forgone that person to actually manufacture, then this 30,000 is opportunity cost. Does that make sense? Please
Yeah.
feel free and ask.
Yes.
I'm here to teach you. Do you get it? So opportunity cost is when the thing has actually happened, the thing is happening, right? Now, there's somebody there. You are foregoing that one. That one is there right now. You forgone it to obtain another one. Then that is opportunity cost. But here you are saying that, oh, this one can be rented for this amount. Okay. And then there's a decision to take it up, but there's no one to rent right now. Meaning it's notional. It's just in your mind. It's not real. Does that make sense? Does that make sense?
Yes, sir.
Now, when we get to discounting, I'll explain to you, right? If you see in the decision-making question, okay, and then there's a cost of capital, that interest has already been inculcated into the cost of capital. So making the interest you see in the question irrelevant for decision-making because we always consider time value of money in the interest, the cost of capital that has been. Don't worry about it. Now, we are going to look at people's background. We are going to look at some few things and just try to understand some few things. So first of all, we are going to look at how to deal with an incremental cost statement. Can you see? Can you see how to do it? I want you to put the format down. Sometimes questions can come in this format, right? Where you are going to use incremental costs to what? Take decisions. And mostly with incremental cost decisions, it is possible that based on the question, you see an increase in contribution. And all you have to do is that you group all the benefits. It's like management accounting is all about a cost benefit analysis, right? Considering the benefits and the cost and weighing the two and see which is better. So if the cost is more than the benefit, then it's a loss. If the benefits are more than the cost, then it's a net benefit or profit, right? So with an incremental cost statement, all you are doing is grouping the increase in revenue against the increase in cost, right? And then the difference. So it looks like this. So you see that you have what? You have any additional revenue that arises against any additional contribution. Then you add savings in cost. And you guys know about savings, right? In case when you look at an alternative, you are incurring a cost. And then that cost, you are not incurring it again, meaning you are saving. When you understand that thing in management accounting, it becomes easier. If I decide to go, I will incur 10 cedis. What if you don't go? Then you save that 10 cedis. Does that make sense? Does that make sense? Do, incur, don't do, save. A cost is either incurred or saved. Does that make sense? Revenue is either earned or lost. So if I go to the party, I will get a tip of 500 cedis. If I don't go, what will happen? That means I'll lose the tip. True or false?
True.
That is how we look at management accounting. If I go, I incur this cost. If I don't incur the cost, then I save it. Revenue, I will earn. If I don't earn, then I lose it. Does that make sense? These are techniques that you have to really understand, and the management account will become a sure banker for you. Makes sense? Makes sense? So write out have you put down the incremental cost statement? Have you put it up? Have you written it down?
Yes, sir.
Please do. Please write it down, right? So always you start with what? Your benefits. And under your benefits, you have what? Maybe there could be an additional, it depends on the way the question is put, right? Any additional revenue or additional contribution, okay? Then you what? You add any increase in cost savings, right? Increase in cost savings. Maybe there were some cost savings. They'll go and add up to it, right? So this becomes your total benefit. then you are going to less what? Incremental costs. You are going to less incremental costs. So incremental costs, if there are any additional costs, right? If there are any additional costs or loss in contribution. So maybe it was a loss contribution, right? Your contribution reduced, you lost that contribution, or a lost revenue, right? Loss in revenue. Remember, if you do not earn revenue, then you lose it, right? Maybe because of not taking a particular decision. Now, when you compare the two, the total savings or the total benefit against your total cost, you now get a net benefit or a net loss or net cost, right? And that will tell you whether the decision should be a better one or it should be what? One that should be what? Ignored or not taken. Do you all get it? Have you put this down? Please, we have a lot to do, so let's speed up a little. Can we go?
Yes, sir.
So with that said, let's take a simple question, right? So I hope you can all see my screen.
Yeah.
So the finance officer of a pizza joint located in Osu, known as Chicken Republic, produces the following incremental cost and revenue data to aid your decision. As a management accountant, revenue from sales of pizza is 25,000 for the year 2015. The management is expected to avoid wastage in flour and yeast combination by 20% of sales in the same year, right? So what are we seeing here? Revenue, is it relevant or irrelevant for decision making?
Relevant.
Relevant. And they say you are going to avoid wastage in flour. Avoiding cost means you are saving the cost, right? True or false? So that means there's a cost saving of 20% of sales. And they said the cost of the pizza restaurant at the time of construction was 10,000. Relevant or irrelevant?
Irrelevant.
Why?
At
Because
the time of construction, that was a issue. I don't know actually. It's past.
yes,
So
it's in the past.
it's a past cost.
Yes, after constructing the pizza restaurant, before you are going to decide whether they are going to buy or not buy the pizza, true or false? So if you construct and they don't buy or they buy, this cost is irrelevant to the decision, right? It's a sunk cost. Do you understand? So this cost is irrelevant. They said additional cost of 2,500 was incurred in buying of spices to give taste to the pizza. Relevant or irrelevant?
Relevant.
Relevant. The word there was what? Additional, please. You must open your eyes in questions. They said additional cost. Additional. What is another word for additional?
Incremental.
Incremental. So additional cost, we will incur additional cost of 2,500 to buy spices. Is it relevant or irrelevant?
Relevant.
Relevant. It is anticipated that not all the pizza produced for 2015 will be sold because of heavy demand in December last year. The loss in sales is estimated at 1,500. Relevant or irrelevant?
Irrelevant.
Look at it carefully. Look at it carefully. We haven't lost sales. We haven't lost sales. So loss in sales is 0. But now loss in sales has increased by 1,500. Is it an additional loss or it is not?
Relevant. It's additional loss.
It's additional loss.
Incremental. Incremental doesn't mean only an increase. It could mean a decrease too. Anytime something, when we say, do you know that in mathematics, there's nothing like a minus? Minus is not real. You know that. It is only addition of a negative number. Do you know